Well, the financial boom earlier this decade played a critical role in growth in developing countries between 2003 and 2007, but tighter conditions in the future are expected to result in weaker growth over the next 5 to 15 years. That's one of the findings of the World Bank's annual flagship report entitled Global Economic Prospects 2010, Crisis, Finance and Growth. Joining me with more is Andrew Burns of the Development Prospects Group at the World Bank. Andrew, thanks for making the time to come in and see us today. Here you're on a whistle-stop tour of Johannesburg.
Indeed.
The report says that while the worst of the financial crisis might be over, the recovery remains fragile. What are the risks that lie ahead as you see them?
Well, there are any number of risks. We're in a period now where, in some sense, we're having a technical recovery. It's being driven by the inventory cycle. It's been driven by fiscal and monetary policy stimulus. Both those effects are going to be much less important in the months to come. So that's going to slow growth. The big question of how strong the recovery will be and how enduring is going to depend on the extent to which consumer demand and investment steps in. With the banking sector still in trouble, that remains a bit in the question. Same problem from unemployment on the one hand. So that's going to be an enduring drag on growth. And of course, households are rebuilding their balance sheets as well in many countries.
And of course, we know so far that the recovery has really been a jobless recovery. We saw figures out of the United States on Friday that showed retail sales slightly better, still not very good. Consumer sentiment still very weak. At what point do you think that we need to see this consumer demand coming in to replace the stimulus and the inventory building? Where's the tipping point here, do you think?
Well, the storyline depends on the country. The United States, there we see the inventory cycle component of demand remaining very strong for much of the year. So we expect that growth there will remain relatively robust for the next couple of quarters, even if the consumers remain a little bit to the side. Of course, the sooner they come in, the better the long-term durability of the recovery is going to be. Europe is a different story. There, the amount of impulse that we're getting from some of these technical factors is less strong. The fiscal policy was less proactive there. Monetary policy also a little more cautious. As a result, that recovery is already sort of stalling a little bit in the fourth quarter. We expect that to pick up in the months to come, but still it's a bit of a question.
Of course, as you point out, although we might be past the worst of the crisis on a tentative recovery phase, the repercussions are still going to be felt for the next decade or so. Are we talking across the board here, developed countries and developing countries?
Well, I think certainly we're going to be feeling the implications of the crisis for some time. One of the points that we make in the report is that although we do have a recovery, we expect that recovery to continue. For Africa, for example, we're expecting growth to be 4.3, 4.7% in 2010, 2011. Those are historically very good numbers for Africa, even though they're less strong than what we've observed most recently. What that means is that we're going to recover, we're stopping declining, but we're not going to have a strong enough recovery to undo the damage that has been done by the recession. You've got to remember that recession, global growth fell by 2.2% last year. It's never fallen before, and then this is just a historical event. Ultimately, what that means is that even in 2011, given the projection that we have, we're still going to have high unemployment, we're still going to have firms under stress, and we're still going to have governments struggling with dealing with the social costs, which are very real, and their budgetary conditions, which are going to be ever tighter.
Then you look at countries like China and India. China actually trying to rein in its growth because it's above 10%. It wants to rein that back down to 8%. Are these just anomalies?
Well, certainly China is a bit of an outlier in there. When we look at industrial production, for example, Chinese industrial production is more or less back where we would have expected it to have been had there been no crisis. You look at high-income countries, it's completely the reverse. We're actually currently operating about 14% below the level we did in January 2008. That means we've got 2 years where there's been no growth for much of the global economy, and that's going to take a long time to recover. In the case of China, exactly as you said, they've recovered, they've gotten back to where they were, and now they're really struggling with supply side constraints and how to find the right level of growth given prospects there.
How does South Africa fit into this picture? Because we're not quite seeing the growth that we're seeing across the rest of Africa. We're not going to have 4.3% this year, I'm sure. We're not quite as slow as we're seeing in Europe. Are we somewhere in between the two?
Well, I think that's absolutely right. South Africa's been going through a difficult period for the last several years. It didn't really benefit from the boom in global growth to the same extent as some other countries in the subcontinent did, partly for structural reasons. The lack of electrical infrastructure was holding back demand, but there are other factors as well. So when we look sort of broadly forward, we expect South Africa, like much of the rest of the world, to be growing at slightly lower than its potential output growth rate. The issue there is that potential output grows somewhat less quickly in South Africa than in China, for example.
How about trade flows? Are you seeing this shift in trade flows that are becoming more developing country to developing country and away from the developed world? Is that sustaining itself as we move past the crisis?
Well, one of the big sort of stories that I think is revealed in the report is that if you take sort of a step back and say, well, what explains the growth boom in developing countries? Is it, as we hear so often in the papers, a story of very strong growth, a demand in the United States and in high-income countries that sort of spread to developing countries? The reality is that's not what happened at all. In fact, growth in high-income countries was slower during the boom period than it was during the 1990s. Even import demand in high-income countries was growing less quickly during the 2000s than it was in the 1990s. What happened was developing countries increased their supply potential. They put in place the reforms that allowed their productivity growth to step it up. And as a result, they grew market share. They grew market share in high-income countries, but also, as you point out, they were increasingly trading with one another. So when we look at the data, they're actually the rate of growth of trade between developing countries was almost twice as fast as the rate of growth between developing countries and high-income countries.
And do you see that continuing as we move forward?
We absolutely see that continuing. The basic fundamental trends that set that up are still in place, and they're likely to continue to be so for some time.
How about issues like growing governments' indebtedness and a growing regulatory environment? Do you see these as risks to the recovery? Do you see these as necessary at this stage?
Certainly, we see them as important influencing factors of the medium term. For the recovery itself, the next couple of years, they're probably a little more marginal. There, we're really more struggling with getting back, recovering the balance sheets and the sort of typical demand or cyclical response issues. But the longer term issue is that as we move from a situation of very loose monetary conditions globally, where there was ample liquidity, low interest rates, to one in the future where the regulatory environment is tighter, interest rates are higher, liquidity is less abundant. That's going to have influences both for high-income countries and developing countries. We estimate that it could reduce the trend growth rate in developing countries by between 0.2 and 0.7% over the next 5 to 7 years. So yeah, it's going to have a big impact.